All right, I'm going to walk you through taxes, and I'm going to start with having you take a look at this list that's in eCampus, of course. But the first thing I want to do is talk about gross income, and we're going to do that using Bart Simpson as an example here. But anyways, the gross income is all taxable unless it's specifically stated as a exception or a reduction to your income. So don't try to guess or rationalize whether something should be or should not be. Look at the lists when you're doing your homeworks. All right, so let's look at this example I have here. This is Bart Simpson, and these are the items that were receipts that he got during the year. So let's go through and decide whether it should be included or excluded. And we're going to start with wages, and those are definitely included, every bit of them. And what we're going to learn is it's going to go on line 7 of your 1040 on the first page. We've got holiday bonuses, all very much taxable, and again on line 7 of your 1040. Now, as far as the lottery winnings go, those are also taxable. Now, you can net losses against them, but we're going to keep it simple. And that is line actually 21, which is the other line because there's no specific line for that type of income. Inheritances, not included, and it's actually written right there as one of the exceptions if you look at the list, and that's because this and life insurance proceeds, those have all been purchased with after-tax dollars, so it doesn't make sense or it doesn't seem fair to tax them again. If you happen to have a side business or a business that you have income from, you have to pay taxes on it, except it's not the whole amount. It's just your net income. So you get your revenues minus your legitimate business expenses. You have to fill out a Schedule C, and that Schedule C will have just the will have all your revenues and expenses listed, but on line 12 of your 1040 will be just the net income. So that's all you get taxed on. Now, as far as interest goes, I've got different interests here. The rule is that interest is taxable unless it's a state or municipal government bond. And the reason state and municipal government bonds are not taxed by the IRS is that the federal government's trying to make it cheaper for the cities and states to borrow money. So with it being tax exempt, they don't have to pay as high of an interest for those borrowed dollars. So in this case, this one is excluded, but you still have to put it on line 8B. And so they want to know, what are you not including for interest? This interest, even though it's a governmental agency, it's not a city or a state, so that is taxable, and that would go on line 8A. Likewise, for the interest on the Springfield, even though it's got a city name in it, doesn't make it a tax exempt interest situation. And then your interest on your savings account would also go on line 8A. Now we've got here number 11, amounts stolen from the church collection plate. You may laugh, but that is all taxable. And because it's not earned income and there's no other line which to put it on, you put it in the other line. Now I put that here just because I want to emphasize, unless it specifically says it's excluded, any income you get is considered taxable. Now, Al Capone probably wished he had included the stolen amounts on his tax return, because that's how they ended up incarcerating him or proving him guilty, was for tax evasion, not for all the heinous crimes he committed. Anyways, as far as number 12 goes, gifts. Gifts are not taxable, they're excluded. However, if a person gives over the maximum amount per person, which is well over 10,000 now. I shouldn't say well over. It's over $10,000. They have to pay a gift tax, but that's beyond the scope of this course. Number 13, ordinary dividends is taxable, and that is going to go on line 9A. There's also a line 9B that we won't deal with in this course, but it's called qualified dividends, and qualified dividends have tax preferential treatment. So let's say you're in a 25% tax bracket. Those qualified dividends would only be taxed at 15%. Scholarships. A lot of you have probably received scholarships. Do be aware that if that money that you received was more than what you spent on tuition, fees, and course-related materials, you got to pay taxes on it. And it goes on line 7. So in this case, Bart got $800, but his tuition, fees, and course-related materials were only $10. Wouldn't that be nice? So $790 would be considered taxable. When you add up all of this and assume that he had no other reductions or exceptions, his adjusted gross income would come out to be, I think it's $1,685. Let's see what that would look like on the tax return. All right, so here is the first page of the 1040. You get your name and address, and then here I want to point out the filing status here. I have it as he's single. The only two categories we'll deal with here is single and married filing jointly. Although there are others, we'll only deal with those two. This next section is important. If you are not being claimed on anybody else's tax return, you get one exemption for yourself. If you are married, your spouse, you and your spouse, and any dependents, you get an exemption for each one of those. So for myself, I have myself, my husband, and I've got 2 children. So I would claim 4 exemptions. That's important for when we get to the second page of the 1040. But for now, let's continue with the Bart Simpson. So here, if you look, we have the income section. So I put in all of the line 7 here for Bart. It was $897, and the taxable interest was $111. $50 though was tax exempt because it was the city bond, and we're including all his ordinary dividends, not qualified dividends. Don't worry about lines 10 and 11. Line 12, this is that business, that the paper route. That's your business net income. You have to fill out a Schedule C though to show the revenues that, or the expenses that you netted against your revenues. We won't deal with any of these others other than the other line 415. Excuse me, line 21 has 415 in it. The others you may, of course, in real life face them, but at this level we'll keep it simple. The latter part, or the bottom part here, the only things I want to really point out to you is that there is a section here. If you look at line 33 and 34, these may be very applicable to you. If you, once you graduate, you're going to have to pay interest on your loans. Well, that is a deduction, reduces your adjusted gross income, which is a number we carry forward on the next page. But anyways, that adjusted gross income will be lowered by interest and tuition and fees deductions, but actually in this class we're not going to use tuition and fees deductions. We're going to use something that actually is more lucrative for you, and that's called the American Opportunity Act, or American Opportunity Tax Credit. But we'll hold off on that. So assuming nothing here, then $1,685 is Bart Simpson's adjusted gross income, and that would get carried over to the next page.